Hello and welcome to Wealth-ology. For today's video, we will teach you how to invest in stocks for beginners this 2022. Are you ready? Let's get started. Number 1. Get your emotions in check. Those who can handle emotions will be one of the things that separate average investors from quality investors during these times. Here's an example. At a relative's funeral, Jordan Peterson suggests that we be the trustworthy ones. It's critical that we expand on that advice and apply it to investment. Investing during and after a market crash in particular. This is the mindset that 90% of investors adopt when their stocks rise in value. They are overjoyed. They go to the bar to tell their pals how much money they've earned. They checked their stocks weekly, if not daily, and their emotions are all wrapped up in the stock market's ups and downs. The small percent of investors, on the other hand, are individuals who do the exact opposite of what those guys do. When their stocks fall in value, the winners are genuinely thrilled because it has become less expensive. They can now purchase more. They understand that the lower the price at which they purchase stock, the bigger their long-term profits will be. It's because of this exact concept that Buffett says, quote, "You're dealing with a lot of silly people in the marketplace. It's like a great big casino and everyone else is boozing," unquote. Buy low, sell high. Unfortunately, most investors do the opposite. Number 2, choose an area that you are competent in. If you want to have an average over other investors and get large returns, you should invest in sectors that you are familiar with. So, we urge that you take a step back and evaluate the topics that you are familiar with. It may be gaming, artificial intelligence, social media, or some other form of technological enterprise if you're a young man. If you're older, you may have an advantage in more established businesses. Perhaps hospitality, travel, wine, food, or something similar comes to mind. Buffett only invests in more established business models that he is familiar with. See's Candy, which sells sweet items, is an example of a long-standing business strategy that Buffett understands. All things like insurance, which Buffett spent a lot of time learning about. He is so knowledgeable about the game that he can identify companies that are worthwhile investments. And you should be doing exactly what Buffett is doing. If you're young and enjoy gaming, you probably know more than most about which firms will lead in the future and which industries will flourish. That is why one of Peter Lynch's most famous lines is both simple and brilliant. He says, quote, "Know what you own and know why you own it," unquote. After all, most investors aim to make money in any business. They want to tell their buddies about all of the businesses they own at the bar. However, they rarely stick to industries that they are familiar with. They rarely have a clear understanding of what they own and why they own it. That is why you should not follow the majority of investors. Number 3, learn the games first. If we just approach a stranger who had never played poker before and ask, quote, "Do you want to join me and my pals for a game of poker? Will you each put in $500? Unquote. If he accepts the game, that individual will be foolish. He was going to get creamed and lose money because he'd never played before. And if we apply it to the stock market, you'd be surprised at how many novice investors don't understand the fundamentals of investing, and it's certain that they'll be creamed after 2 or 3 years. If you're new to the stock market investment game, especially in these perilous times of 2020, here are some fundamentals to be aware of. The price to earnings ratio. One of the most crucial variables to understand is how much you pay for a stock in comparison to how much it earns. Another factor to consider, returns on equity, which is an excellent indicator for determining how profitable a company is. Are you familiar with stock market orders? What exactly is a limit order? A market order, perhaps? A limit stop order? Before you invest, you should be aware of the following. You can use a variety of core ways to determine how well you comprehend something, aka Warren Buffett's value investing method of buying at a discount to intrinsic value. Do you have any experience with a dividend aristocrat strategy, a set of equities into which you can dollar cost average and, according to history, beat the market long term? It's critical that you understand these essential methods and small approaches that you might employ. Before you become an investor, familiarize yourself with PE ratios. Number 4, ignore the minutiae. This is one of the easiest rules to invest in, but it is also one of the most difficult to follow. Most investors are preoccupied with stock market news daily, weekly, and bi-weekly. Every time you receive a piece of news, you get a dopamine rush. As a result, 90% of investors are fixated on the stock market's short-term fluctuations. However, it has a negative impact on the way you invest and, as a result, your investment results. One of the drawbacks of looking at the very short term is that you miss long-term patterns when looking at the stock market for a week or even a month. These are usually little dots of a larger term pattern. So, as an investor, if you are focused on the short term, you will make decisions accordingly, and it leads to lower overall investment results, which is why Buffett advises, quote, only buy something that you'd be perfectly happy to hold if the market shut down for 10 years, unquote. Don't be concerned with the daily news and don't be concerned with the details. Number 5, know your market cycles. Market cycles are the next thing you should be learning about, especially as we approach the end of the cycle in 2020. Now we can see which stocks perform better throughout various time periods. This is an old school graph that will assist you. As you can see, transportation, technology, and capital goods stocks perform well during the early to middle stage of the market cycle. Why? Because things are starting to expand and the economy is heating up. Transportation is becoming more important. During this period, technology stocks are usually selling for a song and can soar. If you wanted to invest in Netflix, Tesla, or Amazon 10 years ago, it was the best moment to do so because the market was just getting started. However, as the cycle progresses, more conservative equities began to do better. Consumer, non-cyclical, and healthcare, for example. So, what gives? People require toothpaste, soap, clean water, and other necessities even during a market downturn. As a result, consumer non-cyclical is a safer investment. They also require medical attention. Thus, healthcare stocks are useful in the later phases. As a newcomer to the stock market, you should be familiarizing yourself with these concepts. You must understand which stock perform well and when. Quote, you can buy the strongest stock in the world, but if it's in a weak sector, you can lose, unquote. As the saying goes, Ray Dalio provides historical evidence and connects it to current market conditions to help us understand where we are in the market cycle and how to organize our portfolio for market conditions in 2020. So, if you're a new investor, you probably wish you had started 10 years ago when the economy and market were still in their infancy. But at the end of the day, all you can think about are the current market conditions, and these pointers will assist you in navigating the waters of these distinct market situations in 2020 and beyond. So, which tip do you think is the most useful for someone who is just starting out? Please let me know in the comments section below, and if you like this video, please give it a thumbs up, turn on the notification bell, and subscribe to our channel for more. Thank you for taking the time to watch. Stay tuned for our next video.